Hello everyone, how are you all? Hope you are doing good and I'm good as always. So before starting the session, I'm just going to tell you something. I'm going to, for the timing, I'm not going to share the recorded video of rectification of errors unit because I have recorded the video and video was not visible. So I just thought, and I was kind of annoyed, so I just thought to like postpone for the time being. Right now, we are going to start with the chapter of inventory. Is such chapter which is really easy if you understand the substance or the concept about the chapter. Okay, so I just prepared the notes for you. And I wonder why it is not, why is it not working? Oh, let me just, no, this is well selected. Okay, anyway, let me just pause the video and try. So, the chapter of inventory is your chapter number 4, which might come in your exam for 4 to 6 months or 8 sometimes. What do you mean by inventory? What do you exactly mean by inventory? Inventory means goods. Basically, inventory means goods. Whatever we purchase and whatever we sell are the goods. What do? We do business. In order to do business, we purchase goods and we sell goods, right? Those goods are inventory for us. Inventory could be held for sale. What do you mean by held for sale? We hold goods to resell the good. Okay. Inventory could be raw materials, which could be a manufacturing unit. For in order to manufacture this pen, there are so many elements to be uh, what is it, combined. Work in progress goods. The goods by the time of year ending, the goods which are laying as work in progress, which are not yet finished goods, or which are not, which were raw materials, but not finished goods yet. And then there are finished goods. These are the goods that consist in the inventory. Okay, sir, what is the importance of inventory? Let's keep come to here. If you don't know, this is the trading account. Okay, there are three accounts in the financial statements, two accounts and one statement. Trading account, profit and loss account, and then there is balance sheet. Let me just check whether video is working or not. Okay, trading account, profit and loss account, and then there is balance sheet. Inventory is a significant part of trading account. Sir, this is the format of trading account. Please note this. Opening inventory, opening stock, two purchases, two direct expenses. Sir, what is this, sir? I do not understand anything. Remember, we hated accounts and we just crossed over it. These are debit balances, these are credit balances. In trading account, all these balances are direct expenses. Okay. These are the direct expenses. In profit and loss, we get indirect expense. In trading account, we get direct expenses. Purchase first opening stock, two purchases, two direct expenses. Put this as a by sales. This is the direct income, and by closing stock. Sir, why is stock relevant? Because stock is something that is not yet sold, but it has potential to be sold sooner, later. Later, this closing stock, if you remember, comes to straight away balance sheet inventory. In balance sheet, in inventory, closing stock comes. That closing stock is consists of raw material, work in progress, and finished goods. Sir, I did not understand anything. I will just tell you again. Inventory is something. If you are purchasing goods and selling goods, those goods are inventory for us. Inventory or stock. What consists of inventory? Inventory consists of raw material, finished goods, and work in progress goods, right? Goods that are held for sale, goods that are not held for reproduction, they are held for sale. I mean, some goods that are held for reproduction, sorry, reproduce of another goods are also might come under inventories depending upon the definition criteria. For here, goods that are held for sale is called inventory. What are the goods that are held for sale? Goods that are in the stock with us. Second thing, trading account. This is the trading account. Balance sheet consists of, financial statements consist of trading account, profit and loss account, and balance sheet. Trading account is the first account. In the trading account, this is the format. Please note this. Opening stock comes from the previous year. Closing stock is something we calculated. This is the formula. And the closing balance, if you remember, we have discussed in the last part when class itself. Balance sheet consists of closing balances, not all through the year balances. The balance that is existing on the day in which we are preparing balance sheet is called closing balance. That specific day balance, not the entire year performance. Like which is the balance sheet is the financial position of the business. Okay. We are done till here. Sir, inventory is most significant or most important current asset. Sir, what do you mean by current asset? Basically, I'll just tell you briefly. There is a huge definition for the current asset. Basically, current assets are the short-term assets. What do you mean by short-term assets? Held for sale or held for a period of 12 months on an average, or normal operating business. So, what do you mean by normal operating business? It is irrelevant, I guess, for you. So you will get to know about it in next classes. For example, if current year inventory is increased by 1 lakh, I will just tell you why it is significant. Inventory is very significant because it directly affects the both the financial performance of the business and financial position of the business, which means both profit and loss and both balance sheet. Why? Because if you imagine if you wrongly increase the inventory by 1 lakh, it affects your trading account, right? Trading account will be increased by 1 lakh, which means gross profit will be increased by 1 lakh. If gross profit is increased by 1 lakh, it means net profit will also be increased by 1 lakh, right? Make sense? If net profit is increased by 1 lakh, it means if you remember, the net profit directly goes to capital account. Capital account will be increased by 1 lakh. And we have discussed about this. This is a double entry system. Whenever there is balance sheet question that comes in your exam, just to try to give two adjustments, not just one. Because here it increases by 1 lakh and the inventory which is to be shown in the asset side will be increased by 1 lakh. This is why it is very significant, very important to calculate the inventory. Now, the valuation of inventory. Inventory valuation is conservatism approach or prudence approach. If you remember, prudence approach means the potential losses will be recognized in the year in which the certainty increases or exists. The potential gains are not recognized. For example, contingent asset, it is not recognized. What is contingent asset? Imagine one asset which might come, which might come to you. Potential asset, it is not recognized, but potential liability, contingent liability is recognized. Contingent liability is shown in the notes to accounts of the balance sheet. Provisions are shown in the somewhere in the balance sheet itself. So this is the formula for inventories. Cost and NRV, whichever is lower. Sir, I did not understand anything. Why is it whichever is lower? Let's just do one problem. Wait. See, we talked about prudence approach, right? Cost, NRV, whichever is lower, which is cost, NRV, whichever is the both are equal. So okay, cost, NRV, whichever is lower, NRV. Okay, so we recognize as less as possible because if you overstate your inventory, it overstates your gross profit, overstates your net profit, overstates your capital, and overstates in balance sheet inventory, which is never that value. I mean, obviously, if you overstate something, it is definitely not the original value. It has increased. You have increased the value of it. So overstating something shows exactly the wrong positioning of the financial statements, which is why prudence approaches matter to us in this concept. Let me just check. What do you mean by cost? Cost has three elements. Uh, Purchase cost is related to purchase cost, conversion cost, other cost, or cost that is included in purchasing the inventory. This is important to you. Okay. What is the cost you have paid to get the inventory to your location? That is most important, including freight charges. This is it. Purchase price and duties and taxes, including freight invoice and other expenses for acquisition. Acquisition means purchase. Okay. These are the expenses that are included. But for duties and taxes, imagine if you remember while passing journal entries, I have told of GST, I have told you about who uh, output CGST and AGST and input CG and SGST could be set off. If you remember, input CGST and HGST are assessed to us, which is why we do not recognize here. Okay, we recognize in the assets in somewhere in some other name, not in inventory. So whatever duties and taxes that are refundable, potentially that could be refunded, is not included in the inventory. Next, trade discounts, rebates, duty drawbacks. Duty drawback is also tax. Okay, these are not recorded. I mean, these are subtracted. Sorry, these are subtracted. Cost of conversion. Conversion is not Hindu, Muslim, Muslim, Christian, Christian, Muslim, Hindu, Muslim, Muslim, Hindu. Yeah, actually. Conversion means raw materials that are converted to the finished goods. This is the conversion. What are the costs that are included in the conversion? You'll get it in CA intercosting chapter, costing subject. There are three costs that are most significant, which are material, wages, and overheads. Overheads means basically other expenses, like more or less. These are also included in the inventory cost. Other cost like administration overheads. Interest is not basically administration overheads. Interest is not recorded generally, but if inventory is long-term in nature, for example, if you are in the business of construction of buildings, building construction does not occur within a span of 4 months or 5 months. It takes years, right? In order to construct a building, you take loan. On that loan, you pay interest. That interest is included in the inventory. Okay. If you have not understood the concept, it's okay because it is a bit complicated. NRV means estimated selling price. Means if you sell the inventory today, what could be the value of it? Minus estimated cost of completion minus estimated selling expenses. Here general expenses, here selling expenses. Okay, other estimated values. Basically, I will tell you again. Inventories are valued at a cost or net realizable value, whichever is lower. Cost, what do you mean by cost? On day one, we recognize cost based on the values, based on the calculation we do, based on what that is included in the cost. Uh, NRV. What do you mean by NRV? Net realizable value. Net realizable value. The value that we might realize if we sell the inventory today. Estimated selling price minus estimated selling cost minus estimated cost of completion. Okay. Whichever is lower is the value that we record on the day we purchase inventory. Okay. These are the okay. Another thing, we use technique. Why do we use technique? We use technique because for the every year end we calculate cost of inventory based on these techniques. Okay. Methyl. Oh, sorry. So I hope you have understood what is the cost, what is NRV, and why are we using techniques even though we know the cost of inventory. These are the techniques we use for calculation of closing stock. Closing stock. Closing stock means if you remember trading account, closing stock. This is for the year end. We calculate this. Okay. There are two techniques fundamentally, historical, non-historical. What do you mean by historic? Historic price based on past price. This is not non-past price. Historic also there are two classifications: interchangeable, non-interchangeable. Non-interchangeable, the thing is systematic identification method. Right? Specific identification method. SIM. For interchangeable, there is FIFO, LIFO, weighted average. I have gone a bit faster, but I'll just try to cover this. Okay. FIFO, LIFO, weight average is inventory ordinarily interchangeable. What do you mean by ordinarily interchangeable? Like if you manufacture, if you have inventory as pens, you can sell any kind of pen. Like if you have Santosh soap, you can sell any Santosh soap, right? You are not restricted to sell batch number 2474 Santosh soap to me. If I come to your shop, you can pick and sell the Santosh soap, right? But if I like come to your Xerox shop, and if I ask you to take a print of my hall ticket, we do not give me any other bytes, right? That is non-interchangeable. Minute. Non Not ordinarily interchangeable. Systematic identification method and non-historic cost methods are adjusted selling price. We'll talk about this. Basis of inventory valuation, cost or NRV, whichever is lower. This is inventory can be defined as assets. Okay, we are shown in the balance sheet asset side inventory. It is a current asset. Sell in the ordinary course of business, which is finished goods. Process of production for such a set, which is work in production. Process of production for such. This is raw material. Just read the paragraph. The valuation of inventory, like imagine if you overstate the closing inventory, it overstates the net income. If you understate the closing inventory, it understates the net income. Okay, if you know these two, these are directly related. These are what you say, adversely related. Opening inventory, if you overstate opening inventory, it means your debit side balances are more than your credit side balances, which means your what is it? Your profit becomes less or your loss becomes more. If your profit becomes less, net income will be reduced. That is what they say in the statement. Usually, slow moving or non-slow moving inventory is the basic reason for poor financial performance as well as financial position. Why these two? Because inventory is such asset it affects which affects both uh, profit and loss and balance sheet. To identify such items, first step is to value the inventory in appropriate manner. We are discussing so many things for now, but we have not come to a practical part yet. We'll come soon. Other cost may include administrative overheads. Sir, where is other cost here? I mean, cost of inventory means cost of it has cost of conversions, cost of purchase price, and then others. There are certain elements that are not included in the inventory, which are excluded in the value of inventory. These are here, these are as and as. As means abnormal amount of wasted material, labor, production overheads. Yes means storage cost. I'll just explain you later. Another A means administrative overheads. Another yes means selling and distribution cost. These are the things that are not included in the cost of inventory. What is the list? Abnormal waste, abnormal amount of waste, abnormal waste, storage cost, yes, is done. And another is administrative selling and distribution cost. Okay. But for storage cost and administrative cost, unless these costs are necessary in the production process prior to the further production stage, If you are storing certain goods in order to basically it is work in progress in order like there are certain goods which require some time to what do you say to dry up or to wet up or to convert to something. For that process, if you store, basically, if you remember, if you know, there are cold storages, right? Uh, Rice mills or something, whatever. Those cold storages, if you store there, it can be inventory. And that storage cost can be included because that storage is the must and should for the product. Administrative overheads that do not contribute to bringing the inventories to the present location and condition. If they can't, because administrative overheads is here also, right? But here bring the inventory to the present location and condition, which is why it is included. If they do not contribute to bringing in inventories to the present location and condition, these are not included. Net realizable value, estimated selling price in the ordinary course of business minus estimated cost of completion and estimated cost necessary selling cost to make the sale. There are two systems, inventory record systems. First one is, what do you mean by inventory record system? Let's read this. There are two systems in determining physical quantities and monetary value of inventories sold and in hand. Physical quantities and monetary value. One system is called periodic inventory system. Let's get to the system number one. What is periodic inventory system? It is also known as physical inventory system. Periodic inventory system is a method of ascertaining inventory by taking actual physical count. Right? Based on in order to come to closing balance, in order to calculate closing inventory. Where is closing inventory in trading account? By closing inventory is there, right? That balance is to be counted based on physical count of inventory on a particular date. It is because of actual physical count, the system is also known as physical inventory system. The cost of goods sold is determined as below. Cost of goods sold equal. This is the cost of goods sold. The formula is opening inventory plus purchases minus closing inventory. This closing inventory comes based on physical counting. Okay. Okay, later. Later means not sooner. Later means later. Perpetual inventory system. Perpetual, it is another method of inventory system. Okay. Perpetual means recurring. Perpetual inventory system is a system of recording inventory balances after each receipt and each issue. Whatever we are going to calculate, the methods I have told you, FIFO, LIFO, weighted average, those are the methods. They are based on perpetual inventory system. I'm sorry for my voice because I'm talking too much, which is why I'm kind of uh, missing the words and clarity. Differences. These are the differences you read on your own, we will cover in theory portion. Historic cost methods, specific identification method, not systematic, specific identification method. Under this method, uh, the actual flow of this method is based on actual flow of goods. It attributes specific cost to identified goods and requires keeping different lots purchased separately to identify a lot out of which units in inventories are left. Anyways, keep this. And here comes the actual methods of calculation of inventory. This is a question. A manufacturer has following record of purchase of so on so while he uses various sets. What did they say? Okay, these are these are the purchases. Okay, these are the dates. December 4th, he purchased 900 units at a price of 50 rupees. December 10th, 400 at the rate 55 rupees. December 11th, 300 at the rate 55. December 19th, 200 at the rate 60. December 20th, 800 at the rate 47. This is the question. 1600 units were issued during the year of during the month of December till 18th. Calculate the value of closing inventory. We have uh, total inventory that is lying with us is 2600 quantity, but 1600 is what do you say is issued. 1600 value of inventory is sold, so the remaining is 1000. Since it is a FIFO, first in, first out. FIFO means first in, first out. Whatever inventory comes first to our godown are sold first. That is the presumption of FIFO. Again, I'm telling you, whatever inventory that comes to our godown first are sold first. So these two are pending. 1000 rupees. I mean, 200 into 60, 800 into 47. This is a closing value of inventory. 800 into 47, 200 into 60. Sir, how did you come to this? Because these are the only things that are lying in our stock. They have sold till here. Since we follow FIFO method, we whenever we sold 1,000 units, we sold first 1,000 units, not the other two. We haven't touched these. Okay. But I do not understand a simple thing. Neither do I. FIFO method. FIFO method means last in, first out. People argue that, for example, you have a rice mill and you are a wholesaler. You sell to retailer. There are 100, what do you say, bags. There are 100 bags of rice units. And the first, uh, this is the entrance of the shop, and I come to you, uncle, or auntie, please sell me one rice packet, one rice pack, and you go there and do you think you easily take this and give me, or oh my god, I'm following FIFA method. I will just go to first in, first out, right? It doesn't happen practically. This is what happens practically. So people argue that FIFO is something that doesn't happen practically, and FIFO is something that is more appropriate. But there was a reason, but I forgot it. Let's just read the para if they give us the reason. FIFO method is not used practically. FIFO method assigned the cost of goods. So the cost of goods that have been purchased last though the lot actually issues may be made out of earliest lot on hand to prevent unnecessary deterioration in value. The closing inventory then is assumed to be consist of earlier consignments, and its value is then calculated according to such consignments. Under this basis, goods issued are valued at price paid for the latest lot of goods on hand. Okay, I think I'm just reading the pair instead of explaining it. Let me just get to the question, you would understand better. In this is important, but as per India's 2 or Indian Accounting Standard 2 or Accounting Standard 2, therefore is Read this year, forget this year after you complete CA CPT and CA foundation. So this is something you have to learn. Okay. The format is very simple. To prepare FIFO, LIFO, weighted average, format is very simple. Date, seats, payments, balances. Instead of payments, we use the word issues. Payment is for liquid, cash, or etc., or bills, etc. Since inventory is not cash, we use the word issues. Okay. First of all, what do you do? Okay. Please keep this question also in your mind. Okay. Like 4, 10, 11, 19, 28, right? These are the purchases. 4, 10, 11, 19, 28. Oh my God, sir, why are the other numbers? I'm becoming awful. These are the things that you have sold. Issues. Is on December 5th, you sold 500 units. On 20th, you sold 600. On 29th, you sold 500. Sir, how do we solve the answer? As I said, date, receipt, and then the issues, and then balance. Okay. For everything, there are three stuff. Quantity, rate, amount. Imagine, just close your eyes and imagine if you have purchased something, if even if there is this in the GST bill invoice, like how many units have you purchased, the amount of individual unit, and then the total amount. This is what they have said. Quantity, rate, amount. You are a. For the issue also quantity rate amount, but balance also quantity rate amount. This is the purchase rate, 900 units, and at the rate 50 per unit, we have purchased. The amount is 45,000. How did this come? 900 into 50. The balance is 900 into 50 is 45,000. Okay, we had done till here. On 5th December, we have purchased. The question is, they might have asked about LIFO instead of FIFO, right? Using LIFO method. Okay, well and good. So, on 5th December, issued. We issued 500 quantity of 50 rupees each for 25,000. Is this 50 rupees 500 units? Where are the rupees, sir? Where are the rupees? The rupees are here. Sir, why are we taking receipts and using the rate for issues? Why? Because that is a secret. We have to use the rate of receipts as rate of issues because imagine out of 900 you sold 500 out of 50 rupees. This is what we have to interpret like FIFO method, right? You first of all you purchase 10 pence of 10 rupees. Later you are selling 10 pence of 10 rupees only. You may sell for 50 or 100 or 5 lakh rupees, but the cost of the pen is 10 rupees only, right? So, which is why the rate of this and rate of this will be the same for the time being. So the balance is, how does this amount come? It comes based on 900 minus 500 is 400. 50 is 50. 45,000 minus 25,000 is 20,000. That's it. We have done Bahubali part 1. And now the second. So we have done till here. Oh my god, we purchased something again. Yes, we did. And the rate is different. This is given in question, okay? 400 into 55, 22,000. Just to multiply these two. Then here comes the question. The balance of first transaction comes directly to the second transaction. Again, I'm telling you, do not get confused. The balance of first transaction comes to second transaction, and third transaction value goes directly beside, because the rates are the different. If the rates were same, we can club these two. Since the rates are different, we are showing us two different stuff, right? We are not clubbing these two. Again, I'm telling you, basically, first we purchased 900 units of 50 rupees each, and this is the balance. And we issued 500 units of third 50 rupees each for 25,000. What is remaining to us? What is remaining to us? 400 of 50 rupees, which is 20,000, is remaining in playing in our uh, stock. I'm sorry. One minute. Oof, 900. Okay. This is, we have done till here. The balance of 400 of 50 rupees each unit of which is 20,000 is laying in our godown for now, right? Now, after we purchase another thing, these balance comes directly to you, and this comes directly the down. What is it? After this balance, then we use these two because we do not club this, because these both are same values, and we have done till here. Now we have purchased again 300 of 55 rupees each for 16,500. First, this balance comes here. Second, this balance comes here. Third, this balance comes. Sir, you have said we since these are not same amounts, we are not clubbing. But if these are same amounts, why are we not clubbing? We are not clubbing because of two different dates also. Okay. If you are purchased in the single day, we just could have added here. So basically, in FIFA LIFO method, we do not club at all, I think. Okay. 3,000 of 55 rupees, 16,500 goes directly downside of this thing. My English is becoming awful each day. I don't know like what is happening. And after this, we have again purchased something. This. No, no. I hope just to pass the video and try to answer this. What are the balances that come here? This balance and this balance, and this balance, and this balance coming. Right. Now the list goods. On 20th, we have sold around 3, 4, 5, 6, 600 units. Right? 600 units. 600 units. So since it is a leaf method, first we clear 200. This is given first priority. Second 300. This is given second priority. Third this out of 400, this is given third priority. Since it is leaf, we go like this. Okay, 200 into 60, 200 into 60 first priority, 300 into 55, 300 into 55, 100 into 55 out of 400, 100. Now the twist is, what is the balance that is remaining with us? The balance is 400 into 20,000 remain with us, 300 into 55,000. 55. Why 300? Out of 400, we have issued 100 inventory. And then the 20. Write this one here, and 37,601 here. Isn't it very simple? Isn't it like a game? And then issued 500. Out of 800, we have issued 500, and 300 will be remaining in our stock. 500 of 47 rupees, 23,500 will be the balance we have issued. Now, this comes again, out of 800, 300 comes again. 400, 300, 300. Okay. I have taken enough time for you to build these four concepts. Hmm. Okay. This is basically the value of closing inventory: 20,000, 36,500, 41,500, 46,500, 49,600. Right? And then there is simple average method. And the above question itself, keep that question with you. The simple average in this question is, what do you mean by simple average? For example, there are 5 students in my class, no, our class. One student got 90, second student got 70, third student got 1, fourth student got 100, fifth student got 80. Okay. So your parents or my parents ask me how good am I. So I will just say 90 plus what is the average of the class? What is the average percentage of the class? Divided by 5. If you do it, you get something around, I don't even have calculator. That is the average percentage. So simple average is 50 plus 45 plus 55 plus 60 plus 47 divided by 5 is 53.5 is simple average. 1,000 units valued. 1,000 units are balanced. Remember, out of 2,600, 1,600 units are sold, and 1,000 units are pending in illustration too. Out of those, in those 1,000 units, 53.4 rupees is the uh, average value, and this could be 53,400 will be the value of inventory. And then there is weighed price method. This is something which might be confusing to the people, but it is something you potential like after listening to this. Basically, keep those two questions, two books with you. Bas- uh, Basically, This is another method which is called weighted average price method in price method. So write all dates here, including sale. Like keep sales aside for 10, 11, 19, and 28. These are the purchases. This is common for us. Quantity into your rate equal to 45,000. This is the balance, which is very easy. Now, out of 900, 500 units are sold. This is the balance till now. There is no problem at all. The point is for like 400 units are purchased for 55 rupees and 22,000 we have paid. Here, the average, how does the average come? The average comes based on out of 20,000 is the balance with you, and you have purchased 22,000. How much stock do you have? 20,000 plus 22,000 is 42,000 divided by how much stock is lying with us? 400. How much stock did we purchase? Another 400 divided by 400 is the value of 52.5 rupees. Again, I will tell you in the weighted average portion, the thing is how much is the value that is lying in our stock. How much is the value that is lying in our stock? This is the value. The value plus how much did we purchase? This is the amount we have purchased. This plus this divided by the quantity of 400 and the quantity that we have purchased. Okay, this will be the value. 800 into 52.5 is 44,000. Till here we are done, right? Then we have purchased another stuff, 355 in 16. That this is given in the question, right? And how do you think this value comes? Based on 42,000 is lying with us, plus 42,000 which is lying with us, plus 16,500 which we have purchased divided by 800 which is lying with us, plus 300 which we have purchased. This balance comes. This is how we solve the problem. Just to solve the problem and then asking if you have any doubts, if there is any mistake. Okay. Again, I will tell you if you listen, you can just rewind, but I will just repeat again. We have purchased. Okay, let's get to here. Uh, what are we doing? We are calculating this purchase, this price. This is the balance that is lying with us. 58,500 plus this is the balance. This is the purchase we have made divided by 1100 plus 200 stock we have made. Okay, just to draw these arrows with a pencil. If you do that, you will get this one. This is how you will do. And 54.23 will be directly this for selling price. Okay, this 600 into 54.3 equal to 32,538. After you purchase again, this is what you do. Just user brains of it. Illustration 5 above is an example of weighted average method used in perpetual inventory recording system. In that case, entity would have to use periodic if entity uses periodic inventory system, closing inventory would be valued in this way. Write all the purchases, write all the dates. Write all the values. Write all the purchase, sir. I have written. Write all the weights, sir. How did we do? Oh my god, I forgot how did we do. Closing stuff would have been valued at 10,000. You know how do we do? The way we have done in the previous question itself. These values divided by quantity. This quantity equal to this value. So multiply this and this that becomes this. Okay. That is how we wait a minute adjust answer will come for a and then there is illustration 6. Niche MSXYZ are in retail business following with information update in their records. Find out the non-historic cost of inventories using adjusted selling price method. Sir, I have not read this anywhere. I have not read this anywhere. Okay, sure, no issues. I'm just keeping question with myself. So, remember we have calculated about totals like how the cost of inventory, goods received from suppliers subject to discount and taxes. Keep GST aside. Because for GST we get input tax. For input tax we get ITC. ITC means creditor. Credit means input tax is basically an asset for us, which is why it is not productive to add the value of inventory here. So 15 lakh 75,500 minus 3% rate discount equal to there will be one value. Packing transportation charges are added. Okay, these are the values that are related to the purchases. These are the values that are related to sales. Sales during the year is 22 lakh 45,500. Where is 22 lakh 45,500? This is the sale during the year. Closing stock of inventory at the rate selling price is 2 lakh 35,000. 2 lakh 35,000. Do you think, don't you think there is some logic missing here? Right? And add to this, there will be some value here minus purchases. Sir, why are we subtracting purchases? Because we are basically doing sales minus purchases equal to gross profit. Sir, I have not understood anything here. Just just we have done this in tabular form. Sales, purchases, inventory, inventory. If you subtract sales minus purchase and including inventory, we get gross profit if there are no direct expenses. So here sales and selling, what is selling price? It includes the profit margin. What do you mean by profit margin? Basically, I have told you, I have insisted you on something. Uh, I forgot. Closing inventory is valued at cost or net realizable value, not on selling price. We should calculate the value of cost. Basically, what is selling price? Cost plus profit equal to sale price, right? So it should be valued at cost. Sale includes profit, right? But we should try to get this value. Anyway, sales minus profit, purchase equal to gross profit. This is the value of gross profit. Now, how do you calculate gross profit margin? Gross profit 6,96,659 divided by sale. Sale is this. This is the value of sale, but we consider this because profit is included here. Okay. Divided by 24,000, 24,80,500. Let me just calculate this. 6,96,659 divided by 24,80,005. Sorry, 80,005. It's 28.08%, 28.09% done. So gross profit is the how do you calculate gross profit margin? Why are we calculating this? I'll tell you later. How do you calculate gross profit margin? Gross profit margin is calculated by gross profit by sale into 100. Gross profit is sale minus purchase. If it includes inventory, okay. Sale is this value. Okay, we are calculating gross profit margin. Why are we calculating? In order to find in order to find this, so that we can subtract. Selling price of closing inventory is 2,35,000. Gross profit margin is 28.09. When you subtract this, we get this value. This is the value of closing inventory. I hope you understood the concept. If you want, I will repeat again. I don't know whether you want, but I'll just repeat again. Sale minus purchase equal to gross profit. This is not right, but I'm just simplifying for you. Closing inventory is given at selling price. So selling price includes cost plus profit. So we need this. What do we need? We need this. So to find out this, we are finding out this because we know this, right? We are finding out this. So how do we find this? Sale minus purchase, including inventory, sale including inventory, which is also known as gross profit. Gross profit divided by sale. Sale is this amount. So sale is this amount. If you do this, we get gross profit margin, the profit percentage. Okay. Profit on selling price, gross profit and selling price. Okay. So the selling price of cost of inventory is 2.35 lakh minus gross profit margin 2.35 lakh into minus 28.09%. If you do this, you get 66,001. This is the value. Oh, you have understood this. And then the question number 7, illustration number 7. From the following information and calculate non-historic cost of closing inventories using adjusted selling price method. Says during the year to that given. Cost of purchases 2 lakh. Cost of purchase is given. Opening inventory is nil. Closing inventory at selling price. It's selling price. Selling price includes cost plus profit. Remember this. 50,000. They have asked about the solution. First, we need to find out gross profit. How do we find out gross profit? As we did in the previous question itself, 2 lakh 2 lakh 50,000 is total is 2.5 lakh. Minus 2 lakh is gross profit is basically I'm trying to say gross profit equal to 2 lakh plus 50,000. I mean sale plus inventory minus 2 lakh purchases divided by sales. Again, this is gross profit is equals to 2 lakh 50,000 is the gross profit. Gross profit margin or gross profit percentage is 50,000 divided by sales 2 lakhs plus 50,000 2.5 lakh, which is 20% or 25%. I don't know. 20%. And then cost of closing inventory 50,000 minus 20% of 50,000 40,000. This is how you do. And then I will upload this till here inventory part one, and we will complete the remaining questions later. Okay. What is the time? The time is 1 hour. Within 1 hour, we have covered so many questions. Just please keep on writing. Please write and practice. Also, please like, share, subscribe. There are very little to no views, and I don't really bother to care about the views, but I just need some motivation. Okay. So I just want to know whether this is useful for you. And just to comment me below whether these classes are any kind of beneficial for you. Okay. Take care. Bye bye. I'm not going to eat your time. And I'll try to upload this by this night.